So, Emily, let's start there. What brings the bears back out of hibernation?
Yeah, John, I mean, I think 2021 is expecting a lot of us, and we just saw a huge amount of economic stimulus, probably like we'll never see again in our lifetimes, $2 to $3 trillion in fiscal stimulus. We added $3 trillion to the Fed's balance sheet, opened up these new corporate credit facilities that we've never seen before in history, and it's really been, quite remarkable. And it's unlikely that we're going to be able to repeat something like that again. The other issue that we see is that the prevailing narrative today is that demand just comes roaring back once you see this vaccine becoming widely available. And the challenge is that a lot of that demand's already been pulled forward. If you look at U.S. retail sales, they're up 4% from the prior peak. And as consumers, our behavior has really changed a lot as a result of the virus. You're not seeing people, of course, engage in services, but you are seeing people engage with goods. And as Mike McKee, I thought, aptly put it earlier, there may be a satiation in place here as far as, our purchases of goods. And can you really have it both ways? Can you see that surge in demand coming through again in 2021? It might be hard to do.
Emily, one thing that you've touched on, and I touched on it earlier and pushed forward to this interview because I think it's so important. Keep hearing the word early cycle, but as you've indicated, housing doesn't feel early. The data doesn't look early. The labour market certainly does. That distinction there, Emily, you've identified it. What does it mean for your market calls?
Yeah, in some ways it does feel like we're late cycle. We talked about retail sales and certainly the housing market, but in other ways, we're still emerging from the recession or maybe still in it. Initial jobless claims still coming in at 700,000 plus each week is a big challenge. And, we just saw the November jobs report indicating that we only added 245,000 in payrolls. It's going to take a really long time to emerge from the hole that we've dug as far as the employment market goes. So I think you said it well earlier when you said, it's a challenge to have just one economic call right now. And I think that's really what you're seeing in terms of this huge shift towards the narrative around the cyclicals and the economic reopening. There's going to be challenges. There's going to be bumpiness and unevenness here. And what that means is we're not willing to stop betting on quality. So we still want to own parts of the market with good return on equity, with strong balance sheets, with good earnings stability. And that's brought us to areas like technology and communication services. Those are going to remain overweights for us as we head into next year. But we do recognize that there is some meaningful catch-up potential here, on the value side. We want to be smart about how we engage with value. We're looking at areas like industrials, which are expected to show a nice earnings rebound. They don't need higher rates in order to show market leadership. We're looking at areas like healthcare that have a nice discount relative to the market right now, but we're not ready to load the boat yet on cyclicality. And frankly, we think the U.S. is a better way to play that than international equities today. There's some challenges there that will persist.